right, so chapter 5, we are moving right along. To talk about unemployment tax. Unemployment tax is a little bit different because so far what we've been talking about are taxes and deductions that come out of employee paychecks. Yes, we have an amount that the employer has to pay with regard to the Social Security and Medicare tax, right? They've got their portion that they have to pay. But most of what we've been talking about is just calculating that net paycheck and how do we get from gross pay then to net pay. Unemployment tax is a little bit different because the employee doesn't pay a portion of it. Now, I should back up. Federal unemployment tax, the employee doesn't pay any of it. It's only the employer that pays this. So the employee doesn't see anything come out of their paycheck for federal unemployment tax. For state unemployment tax, and I'll talk to you a little bit about the relationship between those two. For state unemployment tax, 95% of the time that is also the case. Depends on the state that you're in. In Iowa, the employee does not pay anything toward the state unemployment tax. It's a tax that's only paid by the employer. So there's no withholding. There are a few states though where employees will pay some amount, usually it's a fairly small percentage, toward the state unemployment tax, and it's withheld from their paychecks. It's not real common, but it does happen. It does happen in certain states, and there's actually a list of those states. Let me see if I can find it in your textbook here. Chapter 5, under SUTA. Yeah, so on page, if you have the paper book, but if you don't, that's fine. Starting on page 5-13, there is a list of all of the states and what their tax rates are. So Alaska, the employee does have a tax that they pay for state unemployment tax. California, of course, California. Hawaii, New Jersey, New York, Pennsylvania, Puerto Rico, and Rhode Island are the only states and territories where the employee pays any amount. This is only for state unemployment tax. Federal unemployment tax, the employee does not pay any portion. So you may have some problems where you've got to figure out how much, if you've got an employee, you have to pay attention to what state they're in your problems, okay? In your homework, that is important information, and you're gonna use this chart as well, or this table that's in the textbook. It's in your ebook as well, to determine proper tax rates and all of that stuff. But you got to pay attention to that piece of information. All right, so first off, what exactly is unemployment tax? Another tax. There's so many taxes. All right, so we've got FUTA, which stands for Federal Unemployment Tax Act. Okay. And then we have SUTA, which you can guess what this name stands for. State Unemployment Tax Act. So we've got two taxes here. They work together in conjunction with each other. So the federal unemployment tax, the taxes that are collected under federal unemployment are used to administer the overall unemployment tax program. So they don't actually pay benefits. So the amounts that are, am I missing a joke? The amounts that are collected under FUTA don't actually pay any benefits, unemployment benefits to recipients. The amounts that are collected under SUTA, however, do directly pay benefits to individuals who are receiving unemployment compensation. So unemployment compensation, which oftentimes gets confused with workers' compensation. Unemployment compensation is paid to individuals who apply for it and qualify for it who are unemployed. Now, generally speaking, there are different requirements for receiving those benefits. I am not an expert on what those requirements are. I'm not an expert on the beneficiary end of it. But where those funds come from is from SUTA taxes. So the employer pays those taxes to the state unemployment agency. In Iowa, it's called Iowa Workforce Development, is the name of the agency that administers it. So FUTA, it's only a tax on employers. It only administers the system, but it works in conjunction with the SUTA program. So SUTA program, it's imposed on employers and sometimes on employees. I just read you the list of states where employees do have to pay a certain amount. It's the funds that are collected are used to pay unemployment benefits. The tax rate, so the tax rate for FUTA is standard. It's a standard tax rate that is applied across the board. SUTA, however, the tax rates are going to vary depending upon the state. And if you look in the chart, and maybe, well, I don't want to pull that up, but if you look at the chart, here, I'll do this. It's going to take a minute to warm up properly. Pull it up in your book. It's got one of these lovely little things here over to the side. So let's take a look at Iowa. The tax rate ranges from 0 to 7%, and it's only applied on the first $36,100 of income. Remember, our equation, our tax base times our tax rate equals our tax. So in this case, the tax base is not going to exceed $36,100 in Iowa for SUTA. FUTA has a different tax base, okay, and it has a different tax rate. So for both of these taxes, we're talking about applying the correct tax base and the correct tax rate. So just like with Social Security tax, which has that wage base, so any amounts over $160,200 are not going to be subject to Social Security tax, we have a similar tax base for both FUTA and SUTA. Amounts over a certain, wages over a certain amount are not going to be subject to these taxes, but that wage base is different between FUTA and SUTA. And SUTA rates are different between states. All the states have different tax bases, and all the states have different tax rates. Okay, so there's a wide variety of taxes depending upon the state that you're in. So Iowa, it's somewhere between 0% to 7%, so it could be 0. This is for SUTA. On the first, $36,100, so that's our wage base. So if an employee earns more than $36,100 in a year, any additional amount of wages are not going to be subject to SUTA taxes for that employer. They give you some information as well about the benefits and any waiting period. So in Iowa, there's a 1 week waiting period. The maximum amount of benefits, if I get the right, no, I don't. There's no waiting period for Iowa. Maximum amount of weekly benefits is $551. Minimum is $82. The maximum number of weeks that you can receive benefits is 26. Each state is different with regard to their maximums. You can see here's $275 for a maximum in Louisiana. Minimum of $10 a week. Not sure what that would get you. But again, for 26 weeks. So each of the states, so here's one that's $855 maximum a week in Massachusetts for a maximum of 30 weeks. That would be, so this chart in you're gonna need to use this for some of your homework problems. And again, you're gonna have to pay attention to what state the employee is in, okay? All right, let me get to just kind of a little overview of the two different taxes that we're working with here. All right, so FUTA Tax Act was passed back in 1935. So once again, we're talking about the Great Depression era. And it was before that time, if you were unemployed, and during the Great Depression, there was a very high amount of unemployment. During that time, if you were unemployed, you would not receive any benefits. And so this act was passed as part of the New Deal program. And then the SUTA tax as well was passed in conjunction with that. So each state under SUTA has what's called a trust fund. So there's a whole fund where all of the amounts that are collected go into that fund, and then the benefits that are paid come out of that fund. In order to be in compliance with the law, each state has to get their funds and all of their program approved by the federal government, by FUTA. And so that's where the administration of the program comes in, and the costs associated with that help to administer that program for the states. So employers have to pay the tax if either of these two tests apply. If they pay wages of $1,500 or more during any calendar quarter in the current or preceding year, or, so if they've done that, it's one or the other, or they have one or more employees on some portion of a day in each of 20 or more calendar weeks during the current or preceding taxable year. So if they had one employee for 20 weeks, and they don't have to be consecutive weeks, it could be every other week or every, couple weeks here, couple weeks there, 20 weeks during the year, then they would also be subject to FUTA requirements. So, and they've got the definitions here. Calendar week is 7 successive days beginning with a Sunday. 20 weeks don't have to be consecutive, and the employees don't have to be the same employees. So it could be, we're going to employ Anthony for 5 weeks. We're going to employ Kathy for 5 weeks. For each of, so it could be all different employees, doesn't have to be the same employees. Regular, part-time, and temporary workers are considered to be employees. So in determining their status, employees would include any individuals on vacation or sick leave if they're getting paid for that time. Partners in a partnership, they call them members here. Members are in a limited liability company, LLC, but partners in a partnership are not considered to be employees for FUTA purposes. So just as they were not considered to be employees for federal income tax withholding purposes or Social Security tax, Medicare tax purposes, they're also not considered to be employees for FUTA tax purposes. And there are some special rules for agricultural and household employees. All right, this is just going over that whole common law relationship that we have talked about with regard to Social Security and Social Security taxes and federal income taxes. So same requirements for are they an employee? If there is a common law relationship there, if they meet the control test, the behavioral test, and all of that, then they would be considered an employee. So if they're an employee, chances are if they're an employee for Social Security purposes, if they're an employee for federal income tax purposes, they're also an employee for FUTA tax purposes. Okay. So casual laborers would be excluded for this. Foreign students and exchange visitors, also partners and directors would be excluded. This is important. Pay attention to this. I know you've got a homework question that includes some partners and directors as opposed to officers. Like directors, members of the board would be somebody who's considered to be a director. So I know that there's a homework question that involves that. So pay attention to not only the state that the problem is that the employees are in, but also what the position is of those employees as to whether or not they're going to be covered under FUTA. Generally speaking, if an employee is covered under FUTA, they're going to be covered under SUTA as well. So it would maybe depend, there may be some differences with regard to state law, but for our purposes, we're going to assume if an employee is covered under FUTA, they are covered under SUTA as well. I talked about this ABC list to determine exclusion. So free from control or direction. So that again, they're not really, probably not an employee if there's no control or direction that is, if they're allowed to do things their way. If they perform outside tasks that are outside the usual course of business, and if they're customarily engaged in independent trade or business. So some of the same factors that we've talked about before. All right, interstate employees. I mentioned to you that we're gonna come back to this, and I know I'm running out of time here. So I'll probably leave off here, but I had just mentioned to you, we talked about those reciprocal agreements, and I said we're gonna come back to this whole issue of interstate employees. There are some special rules with regard to employees who are working in multiple states as to under which state they are subject to SUTA rules. For FUTA, it doesn't really matter. For every state, that is not really an issue. But when there are multiple states where employees are working and they are covered by SUTA, then the question becomes, well, which state is controlling? So when we come back on Tuesday, we'll pick up here talking about interstate employees and how we determine exactly which state rules and because we've got different tax rates, right? And we've got different tax bases per state. So we've got to determine, well, which state's rules are we going to apply, right? Okay, so we'll pick up here on Tuesday. Today's Thursday, right? Happy Halloween.